Welcome to Stock Art. Today, we are going to learn about moving average. First, let us look into average. In this example, average is equal to total value divided by number of days. That is equal to 971.2 divided by 5, which is 194.24. However, moving average is an average which is on the move. It changes with the addition of a new value to the set of values. So, in a 5-period moving average, only the latest 5 among the set of values are considered, ignoring the old ones. In this example, the old one is ignored. As a result, moving average is equal to the sum of last 5 days closing price divided by the number of days. That is equal to 980.9 divided by 5, which is 196.18. So, how to use this in stock market? There are some points to remember. 1. Moving averages work in a trending market and not in sideways market. 2. When price is greater than average, it shows strength, and when price is less than average, it shows weakness. 3. Alone it may give false signals, and so crossover strategy is suggested. So, what is crossover? And which moving averages to use? Crossover means one moving average line crosses over or cuts over the other moving average line. And, the moving averages to use are: for trading in few sessions, 9-day EMA and 21-day EMA can be used. For trading in few weeks, 25-day EMA and 50-day EMA can be used. For trading in months, 50-day EMA and 100-day EMA can be used. For investment purposes, 100-day EMA and 200-day EMA can be used. What is EMA? EMA stands for exponential moving average. It assigns more weight to the latest values in a set of a given period than equal weightage to all the values of a set. As it gives more importance to the latest values, quality of signal increases. So, the strategy to use is: whenever a smaller period EMA crosses above a larger period EMA, buy. Whenever a larger period EMA crosses above a small period EMA, sell. Example to the strategy. To be continued.